20% sell-off. It's technical, it's psychological, Ross. But is it but the beginning? Are we going to fall further from your perspective?
Look, it's hard to say whether the bottom is actually in or not. There's plenty of sentiment data and positioning data that would suggest there's more capitulation to come. I do think whatever this drawdown looks like, we have done most of it by now. You know, to see a drawdown well past this, you would be talking imminent recession, basically, if you're looking at historical data. I still think, you know, we're seeing cracks in the consumer via the retailers reporting, but the consumer is still fairly strong overall and still has all of that excess savings that we've talked about. Wage gains are still strong. And so while inflation is really weighing on sentiment, and at some point will probably weigh on spending, the consumer is still there, and earnings growth is still there for now as well. So this has been mostly multiple contraction. It has been ugly, but it's actually been, you know, under the surface, not as bad as it looks.
Yeah.
More valuation contraction than anything.
Yeah, that's certainly true, Ross, particularly when we talk about the multiple contraction. The big concern, though, right now is even if this market has found some sort of bottom, the question is there a spring here at that bottom, something that would actually draw a lot of folks back into this market other than just, I guess, a shift in sentiment?
Yeah, it's a great question. I mean, sentiment is great for helping find a low. It's not really much of a catalyst in and of itself. And I don't think there's a ton of catalysts out there. Certainly a surprise to the downside on a CPI print, something that would, you know, let investors know that the Fed might not have to be as aggressive as they laid out. But really, I think you could be looking at an environment where even if we don't have much farther to go on the downside, there could be a lot of really frustrating sideways chop to come while we search for that catalyst to spring us back into the next bull market at this point, because as you've noted, we're officially in a bear market.
When you go cross-asset for us, what are credit spreads telling you?
That is one of the biggest places of concern for me. So high yield credit spreads, they never really retreated when the market rallied about a month and a half ago. They continued to widen out. And so credit spreads are telling you that there are fundamental cracks, particularly down the credit spectrum. It's something that we'll watch closely from here, but they're showing real strain. And if there's one thing to watch going forward, I think it would be high yield credit spreads, because as those widen out, they can be a little more indicative of what the underlying health of the economy is than maybe the equity market.
It's interesting, Ross. I want to talk to you about correlations thereof, because, I mean, actually, crypto was lower earlier this morning. It was tanking as earlier as 10 a.m. So do you think that there is a cross-asset feeling to this and people having to sell out of other positions because of holdings elsewhere, or is this really very much some sort of technical drivers within the stock market itself?
No, I think it's very much a risk-off sentiment across the board. To the note you all made earlier, bonds finally catching a bid and providing a bit of a hedge when they really hadn't most of this year. So I think it's risk-off across the board. So you would be looking to more traditional defensive sectors, staples, utilities.
Ross, can I quickly ask that risk-off?
Sure.
Why did China not help this morning? Why did that sort of all blow away?
It was nice to try and you know, help with a little bit of a bounce, but 15 basis points on a key rate is not going to it's not going to counteract shutting down your mega cities for months. I mean, it's nice, it's great that they're providing some support, but that's not enough to outweigh what they've done on the downside to the economy by continuing this COVID zero policy.
Ross, we still got about, 4 weeks, 3.5 weeks or so before the next Fed meeting. There's going to be a lot of discussion here about that proverbial Fed blitz, whether the Fed actually would either pause this rate tightening cycle or in some cases, I guess, maybe even offer some sort of accommodation elsewise. I guess my question here is, do you think the Fed, A, would do that, and do you think it's even necessary?
I don't think they can at this point. I think the Fed if not dead, is certainly on life support, at least in the near term. I think their credibility would be at risk if they pivoted here, unless there were a meaningful change in inflation data, and that's pretty hard to see, at least in the near term. So I think they're looking at 50 basis point rate hikes in the near term. I think they want to get up to neutral by year end, and then I think they, you know, will have the optionality to look around at the geopolitical situation, at the supply situation, and then what the U.S. consumer demand looks like, and say, all right, do we need to take this into restrictive territory, or can we wait and see from here? And potentially, like a 1994-95, you know, make a few accommodative tweaks on the margins to help boost the economy in years to come.
Are higher real yields doing part of the Fed's work for it?
Yeah, the Fed is getting a lot of help from higher real yields, a lower equity market, and a stronger dollar. So financial conditions across the board are tightening. The problem is they don't want to count on any of those things that are a little bit more out of their control. And they very much, publicly committed to this policy path that they've laid out. So they are getting some help in the sense that financial conditions are tightening from multiple factors. But I don't think it changes what they ultimately know they have to do.